Fantastic. So we're going to make a start. Today we're really happy and really glad to have Ashish Shah. He is a financial coach, and we're going to be talking about 4 steps to start investing. Obviously, the current economic climate right now is very challenging, and we've seen with the amount of money that's been pulled from the UK government for COVID and other things, that actually things like pensions are no longer as secure as they were, and a whole host of big issues in the world that make it a great opportunity for us to start learning how to invest and take control of our own financial well-being. It's in our own hands, and so we're looking forward to actually sharing how we can start to do that. Can we get the next slide, please? So just before we make a start, we wanted to share a little bit about what Tutor Hive is. We are creating a connected and accessible educational ecosystem. And we're doing that by pioneering the future of education through our innovative platform and engaging platform to drive personal growth and development. We're here to try and make the world a better place, one student, one education, one learner at a time. Give the next slide. What we are is a tuition hub. We connect self-learners with passionate and driven experts like Ashish, and what we're doing is we're making learning accessible for all academic and non-academic subjects. We're going to make it fun, going to make it enjoyable, and hopefully you're going to learn a huge amount. Get the next slide. All right, so last thing about Tutor Hive is what we're about. So what we've seen, the problems and the solutions that we're bringing. There's a lot of difficulty in finding the right tutor you get on with. And that's why we have built our Hive matching algorithm that finds the best tutor for you based on your hobbies, your interests, your learning style, your teaching style. And we're bringing that together. Private tuition is also universally unaffordable. The average price of tuition is over £30 an hour. And imagine that in the current climate, where that's why we're pushing for group lessons. We're building group lessons to the core of what we offer to make it more affordable for our students. Tutors are also charged unreasonable fees on other platforms, and that's why we have built out a nectar scheme which allows our tutors to financially earn a lot more whilst they are
how do I do that then?
Once they're
video.
All right, no worries. And that's why we're allowing our tutors to earn more whilst they teach more. We are also have realized the booking process is really inefficient for current platforms. So we're bringing out our mobile app to make that even better. And there are no tailored platforms to exchange educational resources. And so what we've done, we've built a marketplace where you can buy and sell educational resources as well. So without ado, let's move forward. And Ashish, if you want to go to the next slide, and the floor is yours.
Great, thanks for having me. It's great to be here today. So let's just go into it. First, I want to just run through quickly a little bit about myself. My name's Ash. You can call me Ashish. I have a brand called Wealthy Minds. My Instagram is Wealthy Mind of Ash. And I've been working in the wealth management industry for around just over 5 years now. And early on in my career, I decided to start pursuing Wealthy Minds on the side of my 9 to 5, because I noticed that many of my peers, my family, my friends, they were all, in their mid 20s, high 20s, 30s, and they still didn't know for sure what they should be doing with their money. And, money is this thing which basically powers all of our lives. We can't function without it. So to be unsure about what you're actually doing with the money that you're, working so hard to earn, it didn't feel right to me. So I've pursued this kind of this pathway of trying to educate people on how they can take control of their finances and achieve that wealth that we all aspire to have. Before I get into the juicy stuff, you guys can all message in any questions that you have using the chat function. We'll come to these at the end of the session in a little Q&A part so that all of your questions can get answered. And also don't forget that I am a tutor on TutorHive's platform. So if there is anything else that you guys would like to learn about or you'd like to dive deeper into, I'll be starting up my tutoring sessions soon. We'll do group sessions and individual sessions. So you can just go ahead on the platform and book me in. Cool, so let's get started. So today we're going to cover a few different sections. We're going to cover what is investing, why investing is important, who should be investing. I'll give you my 4 steps that will, 4 actionable steps that can get you started on your journey. And I'm also going to share some special tips on how you guys can build wealth that you might not have heard before. So what is investing? Investing is the act of purchasing assets that will appreciate in value or produce some sort of income over time. There's almost no guarantees when it comes to investing, and risk and reward tend to be 2 sides of the same coin. Low risk investments are likely to provide low returns, and high risk investments will usually come with higher returns. Depending on which kind of asset that you choose, there's 2 main types that you might want to look into. There's growth investments and there's income investments. Growth investments, they don't provide an income on an ongoing basis. These investments are something that you will purchase at the start, and the only kind of returns that you'll get are when you sell the investment at the end. For an example of this could be something like Tesla stock, where you buy it, it doesn't provide any kind of dividends on an ongoing basis. And the only form of realizing your returns and your gains is by selling the stock at the end of it. For a growth stock like Tesla, if you invested $1,000 5 years ago, that $1,000 would be worth $9,000 right now, $9,500. So there's a lot of gains to be had throughout all of the different types of options that you might pursue. But it's your job to go and find out how they will work and if they might actually be suitable for you. Alternatively, income assets are something like, an example of this would be a buy-to-let property that's in an area where it's not likely to grow in value a lot, but the monthly rent that you receive from your tenants would be your income source. That would be the returns that you get each month. The main difference between the 2 is the growth ones tend to compound a little bit more. For compounding, it's something that I would like to go a bit more deep into. So if you're a little bit confused about how compounding works, definitely reach out to me or come to one of our group tutoring sessions, and I'll cover that so that you guys feel a little bit more sure about how that works. As an investor, you can be as hands-on or as hands-off as you like. In the past, I think if you ask maybe your parents or your older generations, they were a lot more apprehensive when it came to investing, because for them, they had to go and speak to a professional when it came to investing, whatever type it was, whether it was something to do with property or stocks, anything like that. They wouldn't really go and do the research themselves. They wouldn't trust themselves enough. They would always go to professionals. And the reason for this was that information just wasn't really as accessible as it is right now. But these days, with the tools that we have, we can actually do a lot more. We can learn a lot more and be aware of a lot more that's going on. And this is exactly why, especially with the current environment, with affordability, it might not always be the best idea to jump straight to paying someone for their professional advice. In the long term, it may work out better to invest the money into your own education and start making decisions yourself. So why is investing important? There's a number of reasons for this, and everyone has their own reasons that they should focus on, because everyone has their own circumstances, their own goals and objectives. So here are a few of my own reasons why I believe that it's important, and it always will be important, to invest your money. Retirement is the main one. A lot of us, we think about retirement, we think about pensions and things that are provided us sometimes by our jobs, and we always think it's a long way away. You know, it's a long way until we retire. We've got time; it'll work itself out. We also sometimes assume that the benefits that we'll get from the government, so our state pension, any other kind of benefits like that, should be sufficient enough to help us when we retire. But the reality is that when you do reach retirement, because of inflation, it's going to be difficult to survive on just the amount that you're going to be receiving from the government through state benefits. And so we have to be taking this into control now, and we need to start contributing and having a strategy for what we're actually going to do when we retire. Because no one wants to work forever. I certainly don't. Some people like it, but I myself would like to be sat on a beach somewhere, sipping a coconut. The other main reason that I find investing so important is the income aspect. Now, with inflation being as high as it is, it's now harder than ever to be able to afford a lifestyle that you're satisfied with. I myself have found myself constantly looking for ways that I can increase my income, so that I can live a more comfortable life and also like stay happy. And there are many ways through investing that you can add on a surplus income on the side of your 9-to-5 job, because many types of investments are quite passive, meaning that you don't need to spend a lot of time doing them. You don't need to spend 9 to 5 doing them every day. Most of them tend to take a few hours a week or a month to stay on top of. So if that's one way that you can see yourself earning a bit more money, being able to afford a car or a job or a holiday or anything like that, it's definitely something that you should pursue. And the last reason is something that I've already mentioned a few times. Inflation is the rate of increase in prices over time. And right now we're at a point where in the US and the UK, inflation is at 40-year highs. What this means is that the things that we need on a daily basis, whether it's food, whether it's transport, whether it's housing, it's all increasing in price. You must have noticed the gas bills, the electric bills, everything is becoming more expensive. And so the cash that you have, that you work so hard to achieve on a daily basis, the cash that you've got sitting in your bank account is losing value with every day that goes past. Because with every day, you can buy less and less with that cash that you have. So you really should consider whether it's a good idea for you to invest, because you don't want to be left behind whilst the world is moving on around you. And investing really doesn't need to be as complicated as you might think. It can be as simple as setting up an automated system once and checking it once a year if you really want it to be, depending on your strategy. And you can start with something as little as like £25 a month. So when it comes to the excuses for not getting started, even if you want to, there really aren't very many. So who should be investing? You should be investing, your mum should be investing, your uncle should be investing, and you might even want to consider setting up a fund for your dog. The variable factor will be what type of investments you pursue, how much you'd like to contribute and lock away. But when it comes down to it, the younger you are, the longer you have to ride out any kind of losses, any kind of dips in the market. And so the more risks you can take. In your youth, you have a lot less responsibility to recover if things don't work out. Whereas when you're older, you probably have a mortgage to pay, a family to look after. And so it's difficult to take risks when you have these dependencies and liabilities in your life. So as much as it seems like when you're young and you're maybe not earning as much as you want to be earning, you're working really hard for the cash that you do earn, it might actually be the time to take more risks because you have the most important asset in life, which is time. So let's get into the 4 steps to start investing. Each step builds on the one before. So when you finish the first, you can go on to the second. And if you can't get to the 4th step, don't worry, because many people don't even start the first one. So step 1, figure out your investment goals and your attitude to risk. Often when we think about investing, we get sucked into the returns and how much money can I make, without even thinking about what we're doing it for. Whether they are micro goals like saving for a new TV or a longer term goal like retirement, you should write down these objectives, anything that you can think of when it comes to something that might involve money, and write them down in terms of how important they are to you, how long you want to take to be able to achieve these things. When it comes to my own clients, I often ask them, how much money is enough money? And usually they struggle to answer because we as a society, we're so fixated on more, on just having more, instead of figuring out what our target actually is. Why do we want it? Why do we want this amount of money? And then once you know what you want to do with your money, you can narrow down your options, because some investments may not suit your time scale. They might have a high initial cost, which you might not be comfortable with right now. There's many reasons. But instead of floating around in this sea of different options that are around, start thinking about what you actually want to gain out of this, and what your requirements are, and that will help you naturally narrow down what you could actually invest in. Then you need to figure out your attitude to risk. Your attitude to risk is essentially how much volatility you can stomach. I like to think about it like it's a roller coaster. Some people just can't handle those extreme ups and downs, like whatever it is, stealth, that thought part. And for those kind of people, in investment terms, they would be classed as risk averse. They can't handle the up and the down as much as some other people. And if you're risk averse, then assets like cryptocurrencies and growth stocks that are very volatile, they might not be the most suitable for your situation. And in my opinion, you should never take more risks than you think that you can handle, because the alternative is you invest in something where you might not be actually prepared for what's going to happen, and then you lose sleep over it, you pull out your hair over it, and with that comes the stress, and you just don't want that in your life when you're trying to grow your wealth, because it works in the opposite way. What tends to happen is when you make a loss which was more than you expected, you become more defensive and you curl up into a little ball and you never risk your money again. So always invest within your means of your risk. And the best way to do this is to complete a risk questionnaire. If you head to my website at wealthyminds.blog, I have a risk questionnaire that anyone can take for free, and it helps them to determine what kind of risk level they are, whether you're a low risk, medium risk, or a high risk. When it comes to taking risks, there are four main things that I do to make sure that I'm staying sane and not going beyond my means. Number one is be sure that these risks are calculated risks, and you're not just going off a tip that you read on Twitter and it's going to leave you financially ruined if you don't. Make sure that it's calculated, you've done your research, you've weighed up the pros and the cons, what could go wrong, and then make the decision. Number two is ensure that you have the right resources at your disposal, because you don't want to get into a situation where you don't have the cash to back up what you're doing and you end up owing someone something. Number three is be confident that your decision is the best possible one for you at this time in your life. In many times in my life, I've been in situations where I've looked back and I've said, I wish I didn't do that. But in reality, the only reason I did that at the time was because I thought it was the right decision at the time. And you have to be, you have to accept that this is the way that that investments work. You have to make a decision based on your knowledge at the time, what you're aware of at the time. And if later on something else happens that was outside of your kind of your scope, then you have to just move on and say that you know, it was out of your control at the time, because it was out of your control. And number four is realize that if it doesn't work out, you will have more opportunities in the future. Life is full of infinite possibilities, and something good will always come in the future. Step two, find out what the options you actually have are. Now, when I'm deciding, you know, what options I should be looking at, there are five main things that I take into consideration. These are the kind of categories for different types of investments. Sorry, different features of different types of investments. Number one is barriers to entry. So what is the minimum level of money I need to invest in this specific type of investment? And what is the minimum level of knowledge I need to be able to invest in this investment? Number two is diversification. So in this investment, am I going to pile all of my money into this one asset? And then if there's one problem with this one asset, will I lose all of my money? Or can I spread my money over a number of different of the same type of assets, but maybe slightly different, so that I'm a little bit more hedged, so that if one of those has an issue, one of them loses value, I'm not affected, like my entire amount is still there apart from that one section. What could go wrong? So you have to think about what are the things that can actually happen, and how likely is it for these things to happen. And number four is, what is the historical performance of these things? What does it tend to grow by or produce as an income on an annual basis, or over the last 10 years? That will usually give you a good idea, but you should never base your decision solely on that, because who knows what will happen in the future. And number five is, does it produce compounding growth, or does it produce an income? Because both of those things cater to two different needs for myself or for you as an investor. So let's have a quick brief overview of a few different types of assets that you might want to consider. So for property, so this is like buy-to-let properties. You buy a house, you rent it out on a long-term basis. So a tenant will come and rent it from you. You have an interest-only mortgage, or you buy it out in cash, and whatever the difference is in the returns to the costs that you pay is your profits. And so you make money on the income. And also, if the property that you buy increases in value over time, you also gain some returns from that at the point of sale. Now, when it comes to property, usually you need a quite high investment to get involved in it. Most likely, you'll either need to pay a deposit and stamp duty, and any kind of other fees like solicitors, mortgage fees, anything like that. Or you have to pay an even larger amount to buy the place out in cash instead of getting a mortgage, because maybe you thought that was better. So either way, there's a high investment needed, which means it's a high barrier to entry. When it comes to diversification, you can build a portfolio of many different properties, but the likelihood is that if you have, say, 20 to 50,000 pounds, you're not likely to get more than 1 or 2 properties. And so all of your cash is going to be in this 1 or 2 assets, which isn't very diversified. If one of those has an issue, then it tends to make a difference to your entire capital that you contributed to it. What could go wrong? Many things when it comes to property. You could have issues with your tenants. You could have maintenance issues, things breaking. The property could lose value, and you could be in a position where you're in negative equity. And if you get caught with a bad interest rate, then it might be a struggle for you to be able to afford the mortgage payments. So many different things could go wrong in that position. You will tend to get between 5 and 10% of a return on your investment on an annual basis. Usually that doesn't include the increase in the property's value, because you'd only really find that out upon sale, which might be 5-10 years down the line, depending on how long you decide to keep this asset for. The focus can be on compounding or income when it comes to property. You might choose a property in, say, like London, which has had a very good growth in their values, and the rent that you get might not be as high in terms of the yield compared to other places outside of London, but you're investing it for the value. Conversely, if you choose somewhere that's outside of London, they tend to have lower values, lower increases in value, but the yield on the income tends to be higher. Another type of investment to consider is stocks. And stocks are very different from property in that you can invest with a very low amount. You can start with £25 a month or £100 in a deposit, single deposit. There's really not too much to learn about. You just need to learn the very basic foundation of how stocks work, what they are, what different companies are, but it's very easy to get started. You can spread your capital across thousands of different companies if you really want to, and so it's really good for diversification. You can create a portfolio that is spread across the entire planet and have access to all the major economies, things like that. So it's a great way to have a diversified pot of for your investments. The risks, what could go wrong is the markets coming down. If markets have a crash, if that stock that you invest in, something happens to the company, some bad news, your investments are likely to go down. In the market that we're currently in, we've seen in the last 11 months, pretty much all of our stocks have gone down from the highs that they were in towards the end of 2021. And you can see from the economic environment with rates, inflation so high, interest rates so high, something like this was kind of on the cards to happen. But this happens in a cycle. And so it's a good idea in times like this to get started with your journey, because you'll benefit from the next run as things tend to go up. In terms of returns on an annual basis, again, 5 to 10% is what you'd roughly be looking at. Sometimes in the last like 3 to 4 years, some of my portfolios have done 30, 40, 50%. It just kind of depends on your strategy, how aggressive you are, and also whether you like to go for individual stocks or you like to go for funds, which are a bit easier to get started with, because funds are basically managed by someone else and it's a group of different stocks. So there's a lot less work to do on your part, and you still get access to a number of different companies. So yeah, it's a really good way to get started. And then when it comes to stocks, you can get compounding stocks which don't pay a dividend, or you can get stocks which focus on a dividend and their objective is to keep paying you out a consistent amount on a either quarterly or annual basis. And there are many, many other things you can invest in these days. There's peer-to-peer lending, there's cryptocurrencies. You can even invest in whiskey bottles and wine. But from my experience, when it comes to investing as a beginner, it's a good idea to get your feet wet with investments that have been around for a long time. There's a lot of research out there. There's low barriers to entry, easy diversification, low costs. That's usually the place where beginners should start. Instead of jumping into something where you feel a bit out of your depth, there's a bit too much money involved from your part, and you feel a bit overwhelmed. Number 3 is get to know your budget. So your budget is the engine for your wealth machine. The more disposable income you have, the more aggressive you can be with your investment strategy. Really dig down into your monthly expenditure. In my own experience, I found that when I chose a few things to focus my happiness on, I was able to maintain my happiness a lot better than when I just try and have everything. Because what I've realized in life is that it's difficult to have everything at the start. But if you choose a few things, a handful of things, you feel a lot more in control. So in my experience, when a few years ago, like I wouldn't really be spending any money on designer clothes, on fancy dinners. Even right now, I don't really spend much money on that kind of stuff. But when it comes to my fitness, when it comes to tech that is really going to help me in my life or I'll enjoy, and when it comes to travel and things like that, I'm happy to spend because I really get the happiness from it. But when I used to be in a position where I'd be trying to do everything, trying to go out for drinks every Friday, trying to go and play golf, trying to do all these different things, you struggle to balance everything. So one tip I have is pick a few things and focus on them, and then try and add them slowly, one by one. And another thing to note is that before you start investing, it's a good idea to pay off any high interest debt that you have. In the current economy, interest rates are the highest they've been in a very long time, since 2008. So it's very expensive to pay interest on any debt that you have. To borrow money, it's expensive. So if you have outstanding credit card loans, if you have outstanding loans that you can pay back early without like a big penalty or anything like that, it's always a good idea to pay that off before you start risking your money, because you don't want to be in a position where you've now lost money that isn't yours in the first place. And number 4, create your investment strategy. So you now know your investment objectives, you now know your attitude to risk, you now know your investment options, and you now know your budget. So now is the time to take action. Based on your circumstances, you need to decide which option makes the most sense to you. Typically, new investors tend to go with stocks. As I mentioned before, they have low costs, easy diversification, they can easily be invested through tax-efficient wrappers, and they're very low maintenance. So decide how much you'd like to contribute each month, or whether you'd like to do a lump sum every now and then. Decide where your interests are, and then start looking into how you can get started with stocks. I can help you with that too. You can come back onto the Tutor Hub platform and book in a getting started with stocks session with me, and I can get you started up with your portfolio. Some best practices that I have when it comes to investing is, number 1, make sure that you are never over leveraged. This again means don't invest money that you don't have. You never want to get into a situation where you're not just starting from 0, you're starting from a negative number. That just makes life all that harder. Number 2 is accept that there will always be volatility in the markets. Number 3 is zoom out and take a long-term outlook on your investments. It's easy to get caught into a current dip, a 6-month window, but when you really think about it, your life is a long, long period. You can go for years and years until you need that money for a specific investment or a choice in your life. So always remember that you have time on your side. And number 4, stay consistent with your plan. Don't divert just based on your emotions. You've done research, like take your time to build your plan in the first place and then stick with it. I will finish there just because we're a little bit over time. I will save my special tips for another session. So make sure you come and book in a tutoring session with me and I'll come and give you those tips on investing. But thank you guys for joining me today, and I'll pass it back to Rishabh.
No, awesome. Thank you so much, Ashish, for the insight. That's really good, really helpful. We've got a couple of questions that we've got through in the chat. So if anyone else has got any questions for Ash, obviously it's not every day you get to speak to a financial advisor, financial coach, take this opportunity. So the first question that we've got from Vapi about what are the tax implications of certain investments? Is there a difference?
Okay. Yeah, so there's a lot of, when it comes to investing, there's a range of different types of tax implications that you might incur. So for something simple like stocks, what happens is you buy a stock for a certain price, and then if you sell a stock for a price that's higher than that price that you bought it for, there'll be a capital gain on your capital that you contributed in the first place. And that gain is usually taxable. Now, there's a few different things to cover here. There's capital gains allowance that every person in the UK gets. And currently, I think that's 11,700, but I'll need to check. But that means you can make gains of around that much, 11,700, without paying any tax on it. And then also there are ISAs that you might want to consider. So ISA is a form of a tax efficient wrapper. Anything that you invest in inside of an ISA has no tax liabilities on it. No capital gains tax, no income tax when you take it out, no, like nothing. So And pensions also work in a very similar way to ISAs, a little bit different, but you can also save on capital gains tax in a pension.
Awesome. I suppose one key important bit to know is an ISA you can access a bit more easily than a pension. So if you're using an investment fund to save up for a property or to save up for a purchase of a big event or big item, then yeah, you don't want to put it in a pension. But again, there's a lot to unpack. We can't do it all. You've touched on Bapi's second question around what type of investments have lower capital gains. Another question, again, might need a deeper dive, is would you recommend investing in countries that have lower tax implications?
So it depends in what capacity you are investing in that country, because through an ISA, so in my position, through my own ISA, I can buy stocks from different countries. I can also buy funds which access companies in different countries. So in my portfolio right now, I've got access to companies in the US, access to companies in India, in China, in Japan. So the tax liability doesn't make a difference because it's already in the tax wrapper, because it's in an ISA.
I see. Awesome. Question from Anna, and a similar question from Magna. So Anna's question is, would you recommend Vanguard as an investment platform? And are there any others that you would suggest using?
Yeah, so Vanguard are a really good platform. Their platform allows an investor to invest in Vanguard ETFs. So an ETF, an exchange traded fund, is it's very similar to a normal mutual fund. It's a group of stocks that is managed by a specific manager. But with Vanguard's platform, you only get access to Vanguard's own funds. So it's a very good way to get started with investing. You can access these funds for like the FTSE 100, the US, the S&P 500. You can access a very simple set, I think maybe around 50 to 100 different funds, but you are limited up to Vanguard funds. So you might want to look into what other options there are out there. There are different platforms like Trading 212, Free Trade. They're both very, I think they're both free. I think maybe Free Trade is only £3 a month, something like that. You can access a whole range of ETFs and individual stocks too. And then the platforms like Hargreaves Lansdown, AJ Bell, Fidelity, they have ranges of like thousands of different funds. Each one has their own individual fee set up. So it's always worth looking at the fee structure, the amount of funds, like the types of investments you can invest in, the customer service, lots of things to consider there.
Awesome. So I think that also answers Magda's question around some of the platforms you can use to start investing in the UK, even as an international graduate who's moved to the UK but looking to invest. I'm assuming those also apply.
Yeah.
I think we're going to need to get Bapi a lesson with you. He's got a few more questions around capital gains and reinvestment of capital of capital accumulated through investments. And there's also a question there around companies in the USA like Matterport that you try to invest in, but investing abroad in different brokers, different platforms. I'm going to put Bapi in touch with you, and he can have that discussion. One thing that would be great would be just to understand the different types of funds. You've got ETFs, you've got investing in index funds, you've got investing in green sustainability funds. So just could you give us a quick overview of just what's out there, and then I think after that we're gonna have to say thank you so much for having us, and yeah.
Yeah, sure. Okay, so when it comes to the stock market, there are a number of ways you can get exposure to it. So the first, most simplest way is buy a stock. So let's say you bought a stock let's say you bought Amazon. You wanted to buy one share of Amazon. you'd have to go through a broker or a platform that allows you to buy individual stocks. And you only have exposure to that one fund. You've had to go and do your research to decide, I want to invest in Amazon. So you have to decide what your reasoning is for that. But the alternative, if you're not sure whether it's going to be Amazon that does the best, whether Apple does the best, whether Spotify does the best, whatever it is, if you're not sure, then sometimes it's a good idea to invest in a number of different companies in the same kind of area. So that's where funds come in. And so there are a number of different types of funds. There's actively managed mutual fund, and a passively managed mutual fund, and an exchange traded fund. So there's three different areas there. Actively managed mutual funds, basically there's a manager and a team of analysts, and they've been tasked with a specific area. So say they've been tasked with the US tech market. So they've gone and found maybe 20 different companies in that market, US tech. They've gone and chosen Amazon, Tesla, all these different companies, and put them in they've chosen how much percentage to go into each one, and they've grouped them together into this fund. And now you can go and buy this fund now and get access to all these different companies. Now that's run by a team. The alternative is an passively managed mutual fund, which is sometimes called an index fund. Now, what these do is there's no team controlling what investments go in and out of this. What it does is it tracks an index. And so an index is basically a list of the top companies in a specific sector. So in the UK, the top 100 companies in the UK is on an index called the FTSE 100. The top 500 companies in the US is on an index called the S&P 500. And now what an index fund does is it just copies that. So by investing in a FTSE 100 index fund, you get access to those 100 companies that are the top companies in the UK. And it's the same thing with the US. If you go in and buy a S&P 500 index. Now, an exchange traded fund is different to both of these funds. The first two I mentioned, they aren't traded every minute or every second like stocks are. Stocks have a window when markets are open. So usually 9 to 5 or 9 to 4 is when markets open, or 8:30 to 4:30 or something like that. And so if you put a trade in outside of those hours, it won't go through. You'll be asked whether you want it to go through first thing tomorrow morning or not. And but if you do it in between that window, you'll buy it at that very second. You'll get a quote saying this quote will last for maybe 15 seconds. If you're not, then the price will change. And the same thing happens with exchange traded funds. You can buy those in real time and it will go through at that very second. Whereas when it comes to mutual funds, you put through a purchase and the actual transaction will go through at the next available opportunity, which will likely be the next day. So that's the main difference between all these different types of funds.
Awesome. Thank you so much. That's incredible. And I think what's safe to say, I've learned a huge amount today. And so thank you for everyone who's joined. Thank you, Ash, as well, for sharing your knowledge. Please do we've asked the questions. You can find Ash on the TutorHive platform. What we're going to be doing is we're going to be finding some time that to start some group lessons. I know a lot of people have already messaged me to say, hey, will we be up for it? And joining a group lesson. I think there's a lot to unpack. One thing about investing is please only invest what you're willing to lose, right? Invest within your means. Don't overstretch. It's not a quick money-making scheme. Go to the casino and you're probably going to lose the same amount. If you think about it in the long term, then actually, yeah, it's a slow growth and it compounds and it grows and grows and grows. So hopefully you've got a little bit of knowledge, a little bit of insight as to the things you might want to start considering. Would definitely recommend finding out more before you start your investment journey, and you can hit up Ash on the TutorHive platform. So with that, thank you very much to everyone. Remember to be in the know. And just before we finish, our next webinar is going to be next week, and it's hosted by Martina, who you might recall from a couple of weeks ago. She's going to be talking about how B12 can really benefit brain health. And so we'll see you there.
Great.
Thank
Thank
you.
you, everyone.